Many times when I'm working with a client, they may say, hey, I've got great credit or very good credit. What does that really mean and how much can affect your mortgage payment? So in this video, I'm gonna break down the difference in your mortgage payment if you have a 680 or a 780. But first, look, if you have a 680 credit score, it's not bad, it's not great. At 780, you're gonna get the best terms possible, interest rate and mortgage insurance. But I wanted to break down the specifics so you know how much that credit score is affecting you on your mortgage. What we're gonna do is in this example, use a $500,000 loan amount and 5% down payment, conventional loan. So specifically to that, FHA is a different situation and whatnot, just conventional. Let's talk about MI on that deal or mortgage insurance. Keep in mind, mortgage insurance is affected by your credit score, your down payment, and even your debt ratio. Little thing to keep in mind, when you're getting an interest rate quote and you're looking at that mortgage insurance, ask your loan officer, hey, is there anything easy I could do to get my mortgage insurance down? Such as raising my credit score or even paying off some small debts to get your debt ratio down a little bit. But let's talk about some real numbers. If you have a 780 credit score and you're putting 5% down that example, your monthly mortgage insurance is about $100. If you have a 680, it's $287 a month. That's a $187 difference between a 680 and a 780. And if you have a 720, it's $192. So about $100 difference more than the 780, but less than the 680. Maybe you can't get to 780. Well, if you can get to 720, it's going to make a difference. Now, let's talk about interest rates because it's going to affect your interest rate and or the cost of that interest rate. So at a 780, let's say the market rate is 6.625, paying or costing, let's say 1% of your loan amount. So you're paying one discount point. To get a rate that's also costing 1% at a 680, it's 7%. The difference in that payment, so at 780, the payment is about $3,200, and at 680 with that 7%, it's about $3,326. That's about $125 difference in the payment from a 780 to a 680. Now let's step back. Total difference in the payment, you're looking at about $300, really more, in difference in payment between a 680 and a 780. Wow. Just based on mortgage insurance and your interest rate. So your goal has to be is one, know what your credit score is when you apply or going into it. And ask the lender, are there things I can do to help raise my score? We use a credit score simulator, which is going to make some suggestions. Hey, pay down this credit card, remove yourself from this account, and then repull in maybe 30 days. But there's examples that you can even lower your mortgage insurance and your rate during the loan process.
How?
We just dealt with this where in one example, we helped a client get some of their credit resolved and did a credit rescore to raise their score, which lowered the cost of the rate for the client. In that example, it saved them like $1,000 in the cost of the rate because the rate was the same, but with the newer score, the cost of the rate was less. And we had another example where I saved the client $177 a month in mortgage insurance because we were able to get aggressive on her income, lowering that debt ratio, and paying off a couple small credit cards. So not only should you know what you're looking at and ask those questions, but work with a lender who's gonna have that conversation with you. Hey, to help get your scores up, let's do this. It's gonna get you a better rate, better interest rate, better cost, lower mortgage insurance, right? Hope you found that information helpful. If you did, holler at me if I can help at all. I'd love to be your lender, and stick around for this next video. I think you're gonna like it.